US stocks fall on valuation concerns. Australia's monthly inflation picks up in August, posing questions for the Reserve Bank of Australia. And the Reserve Bank of New Zealand has a new governor from Sweden. That's coming up in our 5 Things in 5 Minutes on Thursday, September the 25th. And then in part 2 of a deep dive interview with ANZ Chief Economist for Greater China Raymond Yeung, he looks at how China is dealing with deflation.
The other one is to ask firms to cut down their capacity, especially for factories and manufacturing industry, so that they would not be able to use to exploit their scale competitiveness in the market.
But first, in 5 and 5 with ANZ, US stocks fell overnight as overvaluation concerns crept into markets. Meanwhile, the key news for Australian investors yesterday was the monthly CPI indicator, rising to 3% annually in August, slightly above market expectations. The Aussie dollar immediately rose 30 basis points against the US dollar on the news, although it fell again overnight as the US dollar strengthened. Here's ANZ Head of Australian Economics, Adam Boyton.
If you take the detail out of this CPI indicator, what it suggests to us is that there is upside risk to our trimmed mean inflation forecast for Q3 of 0.7. And the consequence of that upside risk, if it's realised, is that it could make the November RBA board meeting much more closely run thing than I guess the market had been expecting.
As of 4 a.m. Sydney Melbourne time, the S&P 500 and the Nasdaq were down 0.4%. The US 10-year Treasury yield was up 1.7 basis points at 4.137%. Gold fell 1.3% to $3,767 an ounce. West Texas oil futures rose 2.4% to $64.95 US a barrel. The US dollar index rose 0.7%. That saw the Aussie dollar down 0.2% at 65.80 US cents after its jump yesterday on those inflation numbers. And the Kiwi was down 0.7% at 58.13 US cents. Number 2. Adam says that while recent data has been strong, he still sees another 25 basis point rate cut in November to bring the cash rate to 3.35%.
Be it the pickup in GDP growth, the apparent stubbornness, if you will, of trimmed mean inflation, the sideways trend in wages growth that's been evident for some time, the lift in business conditions we've seen most recently, the little bit of a pickup we're seeing in consumer spending. I guess all of that tells me we are getting, and we are definitely in the tail end of the rate cutting cycle here. I still do think there's one more rate cut to go just to bring the cash rate to a level that I think is neutral. And I think the RBA board would still assess policy to be on the restrictive side.
Number 3. New Zealand has a new central bank governor. Current Riksbank Deputy Governor Anna Bremen will make the move from Sweden to the Reserve Bank of New Zealand in Wellington from the 1st of December. Here's ANZ New Zealand Chief Economist Sharon Zollner.
No matter who the appointee was, it was always going to be pretty unlikely that they would have a significant impact on monetary policy decision-making in the near term. And that's because there's a committee and the governor's only one vote. There's a clear framework that sets the inflation target, the code of conduct for the committee. So there's actually, the Reserve Bank doesn't have a huge amount of choice about what they do or how they do it in the monetary policy space.
Number 4. Sharon says there are other areas a new governor can have more influence over though.
Over time, things like the new governor's priorities influencing the research agenda. There's perhaps a little bit more scope for things like the bank capital review and other aspects. There's a lot more that Reserve Banks do than just set the official cash rate. And over time, I'm sure her influence will be felt. But for now, very much business as usual.
Number 5. Japan's composite PMI was positive in September, although indicated growth was the slowest in 4 months. Services activity remained solid, but manufacturing fell to an 18-month low. ANZ FX analyst Felix Ryan says elevated price growth also seems to be slowing.
For the time being, it does seem that some businesses are choosing to simply absorb the costs in terms of the increases rather than pass them on to the consumer. So then that might mean we don't see a broader increase in CPI going forward. And that may support our view that we don't see the bodge doing anything until January of next year when we see the next 25 basis point hike.
Felix Ryan there. Now, in part 2 of a deep dive interview I did with ANZ Chief Economist for Greater China Raymond Yeung about deflation, we look at what's needed to overcome the problem. He starts by explaining why it's concerning that large businesses are driving down prices, creating deflation to gain market share.
First of all, because that may drive out some of the SMEs and will perhaps add some of the unemployment pressure to the economy. Secondly, is because of the so-called anti-competitive behavior that somehow they really need to regulate. This is a global trend, for all the regulators in the world is going to fight against, anti-competition. So to some extent, Chinese government and the leadership have a top-down mandate to curb this type of anti-competitive behavior by either, window guidance and ask large firms to, first of all, to improve, the work environment for the workers and to fully comply with the social insurance contribution so that all the business have to be competing on a level playing field. This is one thing. The other one is to ask firms to cut down their capacity, especially for factories and manufacturing industry, so that they would not be able to use to exploit their scale competitiveness in the market. So we are seeing mostly this type of measures through the window guidance, which means the local governments and the central governments having a top-down mandate and ask these companies and large firms not to compete that much by cutting capacity and also without lower the price, offered to the market, with a macro reason to, not to exaggerate this deflationary trend.
Just finally, ultimately, to really adjust, you're going to have consumers step up and consume domestically. And at the moment, many of them are still being very cautious because they've seen the value of their homes fall and don't look like they're rising anytime soon. How much of this is a type of balance sheet recession that is dragging on prices?
Consumer confidence is pretty crucial, for China to revive the domestic demand, because the wealth level of household has dropped due to the decline of the property prices in the last few years. And this negative wealth effect has affected their consumption appetite. So what Chinese government currently doing is trying to revive the property market. Some of the top tier cities, even including Shenzhen, start to relax their property tightening. So many more governments are supporting developers to complete the projects to avoid them going bust, because that is a major reason hurting the consumer confidence who bought property before, but they could not get the property or the units delivered. So the government has been doing a lot in order to revive the real estate market. But so far, even after more than roughly 2 years of this type of property supportive policy, the property price continued to drop. And the latest number we've got is that on a monthly basis, the secondary market real estate has dropped by, on monthly basis, 0.58%, according to the number released this week. So we haven't seen this type of policy very effective. But anyway, this is a key issue top leadership really need to address in order to have a genuine recovery of consumer confidence and revive the aggregate demand, so that this excess supply and the overcapacity problem will ultimately be solved. Because the problem is not because China have excess capacity, and other perspective to look at this problem is that because China lack domestic demand. So this capacity used to be able to serve and or to fulfill the demand of the domestic market, but because the last few years we have apparently seen a slash of domestic demand that result in excess supply, and this supply demand imbalance need to be addressed through reviving domestic demand. So cutting down the capacity or anti-inflation will just be temporary measure. I think that for China to restore the supply demand balance more sustainably, they definitely need to revive the demand, especially through reviving the property market.
Raymond Yeung there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, September the 25th. Catch you tomorrow with the latest from US GDP data and what that could mean for the Fed's rate-cutting path. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.